the reason that you have discussions is precisely in order to get to a positive outcome. There is clearly an end point in sight that the United States has, perhaps tilting terms of trade slightly more in their favor than they have been in the past, but nevertheless it's not in anyone's interests for there not to be a settlement, and I think that, that's the logic that will keep the show on the road.
Do you think global markets, therefore, Stephen, are effectively pricing in a positive resolution ultimately?
Well, I think the global markets are taking the view that a positive resolution is likely, but they're also digesting a significant change so far this year, which is that the uncertainties of trade have clearly weighed on corporate confidence, and you're seeing that both in the manufacturing PMIs. Yesterday, the Eurozone PMIs came out and they were poor relative to expectation. The IFO survey came out this morning in Germany, and the expectations component of that, which has been accurate in the past as a leading indicator, that was also poor relative to expectation. And if you just think about CapEx surveys, CapEx intention surveys, they've rolled in the States, they're negative in the Eurozone and in the UK. So, you know, clearly the tensions over trade are weighing on the mind of CFOs, and it could be that we see a reflection of that in the forthcoming earnings releases for the second quarter. Now, what I would say is that so far this year you've seen serial downgrades to earnings estimates on both sides of the Atlantic, partly because with real GDP under pressure and inflation not going anywhere, that means nominal GDP comes down, and that means that operating leverage for companies is not working in their favor. So there is a cloud over earnings, but in the background, markets feel that central banks have their back. That's been very clear from rhetoric from both the Fed and from the ECB in recent months. And the hope is that rationality will break out on the trade front.
You know, there's two ways to slow down, though, Stephen, because there's no question a lot of the data there and here has slowed somewhat, but you can slow down all at once or very slowly over years. There seems to be this sort of, especially with the yield curve here inverted, that, oh, OK, here we go. Recession is imminent. You've probably lived through enough cycles to know you can slow down slowly for a long time. And it doesn't mean that equity markets are going to collapse.
That's absolutely true. And we've talked about manufacturing surveys, but on the services side, things have so far been holding up. They're starting to get dragged down towards the 50 level. But if we just look at signs for employment, both in the US and in the Eurozone, the employment picture looks, I'm not going to say it's untroubled, but it looks fairly robust. And the fact that inflation is low and that wages are rising means that real incomes are rising. So the consumer looks fairly underpinned as well. And we're going to get an important indicator for that with consumer confidence numbers coming out imminently. So over the last 18 months, you've seen this pressure on manufacturing, but not so much pressure on services. And I think that's one of the reasons why markets feel fairly sanguine about the future. However, as I said, you know, we do need some good news to start breaking through, because what you wouldn't want to see is an expectation that in 2020 growth comes under further pressure, and that then clouds the picture for corporate earnings even more.